Okay, we are going to get started now. So it's 7:35, so we'll get started and then people can join us as they log in. So good evening once again, everybody. Thank you for joining us tonight. For those of you who may not know me, my name is Vanessa Rafonja, and I'm the owner director of VA Property Consultants, a estate agency based in Luton, which I started approximately 14 and a half years ago now. Started right here from my house, and it's grown to a team of 6 property professionals where we let, sell, manage properties for landlords, and more recently have started doing things like buy-to-let consultancy and property refurbishments. Today, as you know, it's all about tax and learning and hearing from our key speaker, Robert Glover, who will be talking to us about how to maximise our rental income before tax. For me to introduce Rob to you, who's a VA landlord, who's been a portfolio landlord for with VA for over 10 years, an amazing client and turned friend, I would like to actually just read Rob's professional profile so you get a real understanding of who Robert Glover is and his professional background. So excuse me if I'm looking down, but it's because I want to read his profile so you really do hear more about who Robert is, who we're talking to you tonight. So Rob is a qualified accountant with over 30 years experience as a finance, accounting and tax specialist, and is a professional landlord, property tax expert, and as I said, a VA client. He has a unique breadth of experience encompassing senior finance roles with multinational organizations, including DHL, Booker Tate, Whitbread, and the Dixon's Retail Group, and also in private accountancy practice, working with small owner-managed and medium-sized enterprises, landlords, and property businesses. This breadth of experience gives Rob a strong customer focus and understanding of the needs of a small business and landlords, whilst bringing a big company approach to timelines and response times. For the last 8 years, Rob has specialised in helping landlords and small businesses and property investors save tax whilst remaining compliant with the ever-changing tax law. So that's just a little snippet of Rob's professional background, who you'll be hearing from shortly. Rob has, like I said, Rob has a lot of knowledge that he's going to impact us tonight, right from some of the basics to hopefully some golden nuggets that you may or may not be already privy to. So have your pen and paper out and get ready to take notes. What we will do is Rob will go through his presentation. If you have any questions or anything pops up in your mind that you would like addressed, we will be having a Q&A at the end. Feel free to pop your questions in the chat box, and if we can as well during the question and answer time, we'll also ask a few people to unmute for their questions. But please pop questions as we go along, as they come to your mind in the chat box, and we'll do our best to monitor that and address as many as we can, and as Rob feels relevant, that will benefit the majority of everyone here this evening. Just to kick off, before I hand over to Rob to do his presentation, just to give you a little bit of take on my view of the property market, as an estate agent who's worked in the Luton market specifically for the last 14 years. From a landlord's point of view, we have seen rents higher, probably at one of their highest points over the last 12 to 18 months, despite the pandemic. Rents are rising. There's still very much a shortage of good quality property for rent versus the number of tenants looking. So we are generally finding that if you put a property as a landlord on the market, and this should be similar for most locations that you have a rental property, but this is specifically in Luton. When we're putting properties on the market these days, as long as they're priced correctly, presented for rental properly, and they're promoted properly, we are seeing most properties within maximum 2 to 2.5 weeks, because there is such a premium for rental properties. We're finding that with the effect of the pandemic, more and more people, tenants, are looking to move out of big capital cities. I mean, I'm sure this is not news to anyone, but we're seeing it firsthand as an agent, where people are definitely moving out of capital cities like London and other cities to move more out of London for properties where they can have more space, because they're more and more working from home or hybrid working these days. So people are looking for space people are definitely looking for gardens, and people are looking for parking. So that trend is I think set to continue. Most big companies now, corporates and even small businesses, are operating on a hybrid basis. So you will see more and more people looking for that type of accommodation when they're looking to rent. One of my sort of favourite footprints for rental as a landlord, which always tends to fly, are what we call the 2 up, 2 down. So have 2-bedroom houses, 2-bedroom terrace properties, where you have the 2 living rooms, you have the 2 bedrooms upstairs of good size. Those properties tend to go out like a shot. You have single professionals who want that extra space, that can afford to pay for a 2 up, 2 down on their own. You have couples, you have small families. That type of property always has a massive footprint, therefore a massive demand on the rental market. And obviously, if it's a house and not a flat, you also have the benefit in most cases of having a private garden. So we tend to see those type of property footprints whizzing out of our lettings books when we put them on. But in general, the market is very strong, and it's a good landlord market. And like I've said, it's been like that, I would say, for the last 18 months. We've seen the landlord market really hold strong through the pandemic and the lockdown season. That's just a little bit of my view and my take on the current landlord rental market, specifically in Luton, but I would imagine very similar in other parts of the country as well, if you have properties in other parts of the UK. Now what I'll do, without further ado, is hand over to Rob, who's going to share his presentation screen with us while he discusses tax and landlord. So Rob, over to you.
Thank you very much, Vanessa, and thank you for that great introduction. Couldn't have said it better myself, or written it better myself. So hopefully everybody can see that. Can you all see that? That's good. Glad the technology works. So yeah, good to see so many of you out. Thanks for giving up your evening to attend this event, and hopefully you'll find it useful and helpful. So without further ado, we'll get on with it. So in terms of what we're going to be covering tonight, I think you'll pretty much all have seen the agenda that was circulated, which isn't what you're looking at now, because I've added one item at the top under the heading "Unexpected Good News," which is in response to an unexpected announcement by HMRC last week, and the rest of it is as was published. We'll do a little bit about record keeping, what you can claim, mortgage interest, section 24, whether you should use a limited company or not, and coming clean if you've got a backlog of prior year undeclared income, how to go about coming clean. Okay, so without further ado, so the unexpected good news, a lot of you will have perhaps heard already, that of the announcement that there's effectively an extension to the filing deadline. Many of you may have been possibly in a state of panic or despair at the moment, having to get your accounts ready to submit and your tax returns by the 31st of January, but you've got another month to do it. And if there's tax to pay, you've got another couple of months to pay that as well, whereas normally that would be payable by the 31st of January as well. It's now the 1st of April. And the other good bit of news, this is all under the government's COVID response, by the way, so it's not a permanent, these aren't permanent changes, it's just for this year. And the other thing, point 3 on the slide, is that if you need time to pay, you can pay the tax bill in up to 12 monthly installments, and it's a very simple process. You just go online, you can apply for that through gov.uk. So it should be very straightforward to do that without having to be grilled by somebody on the other end of the phone line, by somebody in HMRC. So I thought I'd just start with that. Hopefully the rest of the presentation contains more good news than bad, but let's move on. So firstly, just dealing with some basic stuff. Record keeping. What records should you keep, and how should you keep them? ultimately, what you want to end up with is something like the profit and loss account on the right, or at least an annual totals for your revenue and everything that'll feed into your tax returns. And to me, the best way of doing that is to have a separate bank account which you use exclusively for your property income and all your expenses. Every time you need to spend any money on your property, use that account, pay all the rent in, and then that saves an awful lot of time and hassle at the end of the year trying to remember what you paid out of where and pulling it all together. And that will at the end of the year you can download a CSV statement from there, drop it into a spreadsheet, and then summarize it into something into the annual totals that you see on the right. Don't, if you can avoid it, use cash to pay contractors. Not for any ethical reasons, although that may be an issue for you as well. But quite simply, if you draw out cash at the end of the year, you can't remember what you drew it out for. So try and avoid that if you can. I know contractors always want paying in cash, but if you have to pay them in cash, what I'd suggest is to do a transfer out of your property bank account into your normal bank account and then withdraw the cash from there. And that way you can put a reference on the transfer which reminds you what it was actually spent on at the end of the year. That's the ideal, and that's the other end of the spectrum. Try and avoid that. Boxes of paper are a nightmare, and it'll take you forever if you rely on putting bits of paper to one side. It'll take you forever at the end of the year to sort it all out, and you'll be doing yourself. You'll be punishing yourself because you'll lose stuff and you won't record all the expenditure, and you'll be over declaring in all probability. And the other things it says at the bottom of the screen here, MTD, that stands for Making Tax Digital. Is coming in for landlords from April 24. Making Tax Digital is the government's initiative for basically ensuring that all the records that go into anybody's tax submissions, be it VAT, self-assessment, corporation tax, whatever, they're all digital and they all link in to the HMRC portal which collects them, so that in this idyllic, perhaps utopian world that's envisaged, you just go into your portal once a year, you press a couple of buttons and your tax return self-populates. Fantastic, isn't it? But the reality is a little bit different. But the point is that will require landlords to keep digital records from April 2024. So the box of invoices just won't be viable then. So better to plan for it now, I would suggest. Moving on to what can be claimed, just to preface this with focusing on those two words at the top of the slide, wholly exclusively, and exclusively rather. So the general rule when claiming any expenses are that the expense has to be incurred wholly and exclusively in the pursuit of your business, or in this case, of your property rental business. If it's not wholly and exclusively incurred, then you can't claim it in simple terms, unless there are some specific guidelines about specific expense types. But the general rule is wholly and exclusively. So what you're looking at here, I mean, all the blobs in blue are things which I think most of you will probably realise that you can claim. So things like legal and professional fees, service charges, ground rents, repairs and maintenance, etc., etc. There's one I'll just focus on in the top right-hand corner: replacement furniture. Now, if you buy a property and rent it furnished, the initial cost of that furniture is not claimable. However, as it gets replaced, then that replacement cost is claimable. So that's a bit of a quirk, but one to be aware of. And then I'd just like to focus on the two in yellow at the bottom, which perhaps aren't so common and so well known. So the first one, electric charge point allowance. That's probably not something that, well, if any of you have got electric charge points or installed electric charge points in your properties, I'd be interested if you just say so by putting a comment in the chat. You know, with the government's plans to get rid of petrol and diesel cars in the next however many years it is, 10 years is it, or no, 2050, so 28 years, that's going to become more and more relevant, and you can claim 100% of the cost of installing an electrical charge point against your tax in the year that you install it. That could be quite important going forward to attract tenants to your home. And then finally, in this section, travel, accommodation and subsistence. So you can claim the cost of travelling to and from your properties. If they're next door, then that's obviously not going to be a massive cost. At the other end of the spectrum, if you've got properties overseas, then that's going to be a significant cost. So if you've got a villa in Spain that you rent out, you can claim the costs of travel, accommodation while you're there, and subsistence, that's to say food and drink while you're there, or reasonable costs of food and drink, not you know, having you know, umpteen pints down the pub every night, but you know, reasonable amounts to keep you going. With that particular example, you need to bear in mind the wholly and exclusively rule. So if you're flying out to Spain and you're going to take a holiday at the same time, then your flight isn't exclusively for business purposes, so you therefore can't claim it. If you're just going out for a day or 2 days, doing a bit of work on your property or doing whatever you got to do and coming back, then it probably will be. And certainly the accommodation and the subsistence costs, i.e. the food and drink while you're there, will be. To give you a more modest example of travel and accommodation from my own experience, I happen to live in Barnet in North London, and I've got some property in Luton and St Albans, so I have to go up there from time to time, and I usually drive, and I'll claim a mileage rate of 45p a mile for my travel there and back. If I get the train, then I'll claim the cost of that. So not a massive amount, but it's worth being aware of and worth claiming. And moving on to finance costs. So we'll cover this one in a little bit of detail. As you're probably aware, there's now a 20% tax reduction given on finance costs generally. That covers two things. There's the mortgage interest. So I would imagine that those of you with mortgages on your properties claim the mortgage interest or claim the 20% tax reduction on it. But what perhaps not all of you claim are refinancing costs. So we all have to refinance every couple of years. The mortgage deal runs out, we either renew it or we go somewhere else. And there's also a hefty arrangement fee. Now, most of the time that's added on to the mortgage and you don't actually part with the cash. But just because you don't part with the cash doesn't mean you can't claim it against your tax that year. You can. You've incurred the expenditure, and it can be claimed and should be claimed. So don't miss that one. And then similarly, brokers fees, legal fees, survey, valuation fees, anything associated with some strange lines appearing on this. I'm not quite sure where they're coming from, but anyway, carrying on. So all the costs associated with refinancing can also be claimed under that 20% tax reduction. And the 20% tax reduction isn't automatic. It is limited to the lower of those three items listed at the bottom of the screen. So the total finance costs themselves, property profits, or what they call adjusted total income, which is basically your taxable income excluding savings and dividend income. It's limited, the amount you can claim is limited to 20% of the low of those three items. But if it means that you can't claim all of the finance costs in a year, you can carry forward the excess and claim them in future years. So moving on to section 24. Section 24 is the legislation that changed the way finance costs were dealt with for landlords, for residential property specifically. And whereas previously you would treat them as an expense, as you would, with agents' fees or with service charges or with any of the other things that you would normally claim, many of the other costs that you would normally claim against your revenue. What section 24 means is that you have to ignore those costs when you're calculating your taxable income, and instead you can take 20% of those costs and reduce your final tax bill by that amount. So what it does is it pushes up your taxable income, and that can have knock-on effects, for example, with child benefits, because it can, and I'll show you an example in a minute which demonstrates what I'm talking about. It can push people from one tax bracket to another. So if you would normally pay just 20% tax, basic rate tax, this can push you into the higher rate band. And in the higher rate band, if one parent of a couple who are claiming child benefit hits the higher rate tax band, you start to lose the child benefit. So it's quite an insidious thing, this, and not everybody appreciates the full impact of it, but it impacts quite a few other potential benefits, as we shall see in a minute. So apologies for all the numbers on this next slide. I was trying to avoid putting any spreadsheets in the presentation because I know that numbers aren't everybody's cup of tea, but I really didn't feel I could avoid doing it in this particular example just to demonstrate how this works. So if I can just run you through this, if you focus on the left-hand column, which is the traditional way of accounting for mortgage interest and finance costs. So this example looks at someone who's earning £34,000 a year. They get £25,000 in rental income, against which there's £12,000 worth of mortgage interest and £2,000 worth of other expenses, which gives them a profit on property of £11,000, total taxable income of £45,000. Because that £45,000 is within the basic rate tax band, it all gets taxed at 20%, which gives them a total tax bill of £6,486. Under section 24, i.e. now, as you can see in the top half of the example, looking at the right-hand side of the screen, the mortgage interest is taken out. So the taxable income of this person is now 57,000 rather than 45, which pushes about £7,000 of their income into the higher rate tax band. And you can see below where the tax is calculated, there's 6,730 taxed at 40%, which brings the gross tax bill up to 10 grand. They get the 20% tax credit for the finance costs, 20% of £12,000 set against that, which gives them a final tax bill of £7,832, which, as you can see, is £1,300 more than in the previous, than before section 24. And this is a classic example of someone who before was comfortably in the basic rate band, but has been pushed out of it by the way this new measure works. And the other thing, I've just put a note at the bottom: if they're claiming child benefit, then they'll lose 70% of their child benefit under this measure and with these circumstances. So it's quite a nasty little rule. And just touching on some of the other effects, first two we've covered, there are all of these other impacts that it can have. Eligibility for £1,000 worth of interest income taxed at 0%. So if you're a basic rate taxpayer, you can earn £1,000 of interest a year tax free. If you're a higher rate taxpayer, it's only £500. Loss of tax-free personal allowance. This would be where Section 24 pushed your taxable income above £100,000 a year. At that point, you start to lose your personal allowances, which really pushes up almost exponentially the amount of tax that you pay at that level of earnings. Tax credits similarly can be affected. Capital gains, if you've got any capital gains in the year, the capital gains tax rate is determined by whether you're a basic rate or a higher rate taxpayer. So again, pushing you into the higher rate band will increase your capital gains tax rate. And if you earn about 200 grand, which for most of us it would be a nice problem to have, it'll restrict the annual allowance, i.e. the amount you can pay into a pension scheme every year. And at the other end of the income level, the marriage allowance is where one party in a married couple can transfer 10% of their personal allowances to their spouse, but you can't do that if you're a high rate taxpayer. And then student loans, if you've got a student loan, you've got an extra 9% tax effectively, so being pushed into or having your taxable income increased in this way is going to be even more expensive for you. So that's the effects. Which begs the question, what can you do about it? Well, the straightforward answer, which isn't a complete answer, is you could form a limited company and you could buy properties through a limited company, and then the profits would be subject to 19% corporation tax, and then taking in general, if you've got a limited company and you want to take money out of it to pay yourself, you'd either have to do that as a salary, which is subject to income tax and national insurance, or as a dividend, which is just subject to slightly lower rates of income tax but no national insurance. However, there is a way of doing it and being able to withdraw for quite a few years without paying any personal tax. You just pay the 19% corporation tax. And I think that's, again, best demonstrated by an example. So if you buy a property for £200,000 through a limited company with a 75% mortgage on it, then you need a £50,000 deposit. So typically what you would do is you would pay £50,000 into the company to finance the deposit, and that would be recorded in the company as a director's loan, i.e. a loan from you to the company. DLA, by the way, stands for the Director's Loan Account. So if you did that, then what you could do is you could get the profits after tax, you could pay the profits after tax to yourself as a loan repayment for quite a few years until that loan was paid back. And those loan repayments would be free of personal tax. So that's quite a good way of doing it. And if you think of what the net rental yield after tax on the £200,000 profit or £200,000 property would be, you can see that you can keep going for quite a few years until you've paid off your 50 grand loan. And at that point, you would have to start paying tax. The other thing, just to stress, finance costs are fully allowable as a deduction against profits in a company. So to be honest, there's a lot of benefits. There's a lot of disadvantages. It is quite a complicated equation, which is why, as it says at the top, yes or no. Well, it depends. It really depends on your objectives and your personal circumstances. So some of the disadvantages, the main one is it doesn't normally work for existing properties, simply because to transfer properties from your personal ownership into a company, that's treated as a disposal. It's treated as a sale from you to the company, and sales are subject to capital gains tax. So you'd have to pay capital gains tax. The purchase by the company would be subject to stamp duty. So, it's very expensive. And then on top of that, you've got all the practical issues about the fact that you can't transfer mortgages. You'd have to remortgage onto a company mortgage. You'd have to change the deeds, land registry documents, all of that stuff. And then, practical cost issue or financial issue rather than a tax one, interest rates and costs of purchase of a property, if you buy it through a company, are still considerably higher than if you did it in a personal capacity. To give you an example of my own, I've got one property that's held in a limited company, which was bought about a year ago, and the interest rate on the mortgage is 3.5%, and I think at the time personal mortgage was, I don't know, probably 1.75%, something like that. So it's a much more expensive interest rate, and the purchase costs were a lot higher as well. The solicitors' fees are more because the lenders make you jump through a few more hoops and give personal guarantees and things. So it is more expensive. In this case, it did just about work for my wife and I, but it wasn't an overwhelmingly clear decision. So just to sum up this section, you should take specific individual advice for each property purchase, because it really does depend on, A, what your objectives are, and B, the individual financial circumstances of yourselves and the property and its cost profile, cost and revenue profile. Finally, coming clean, as I call it. So there are people around, and this may or may not be you, who have undeclared rental income from previous years, and to be honest, that's an increasingly uncomfortable position to be in, because HMRC are actively targeting landlords, and they've got an increasing amount of data feeds from lenders and so forth to enable them to do that. I mean, it is better to fess up, so to speak, and HMRC actually encourage you to do that through the Let Property campaign. And the way that works is a special facility which enables you to make what's called an unprompted disclosure, to hold your hand up and say, look, I didn't, for X, Y, and Z reason, I didn't declare this, didn't realise I had to, etc., etc. And provided you are upfront, helpful, and open, it can reduce the amount of penalties paid to zero. If I'm acting for anybody who's doing this, I want to get them zero penalty. So normally, if HMRC find you, send you one of their very nice letters telling you that they have reason to believe that you've got property income and you haven't been declaring it, then that leads to the fines, the penalties, which are shown in this right-hand column, which, as you can see, depends on whether they believe you've taken reasonable care, in which case there'll be no penalty. If you've been careless, in which case there'll be up to 30% penalty, or if it's deliberate, in which case it's 35 to 70% penalty, or deliberate and concealed, it can be up to 100% penalty. Much better if you make an unprompted disclosure, and what you want to demonstrate is that you've just been careless, you haven't been deliberate, you certainly haven't tried to conceal it, and provided the quality of the disclosure and your conduct in the matter is helpful and open, then you can argue, you can put in a strong case for a 0% penalty. And yeah, I would not want any of my clients to have more than that, to be honest. Yeah, just focusing on the way it works in a little bit more detail. These ranges, to get to the bottom of the range, then it's all about, as it says at the bottom of the screen here, the quality of the disclosure and the conduct. If you tell HMRC about the errors, if you show them what extra tax is due, help them work it out, or do it yourself, even better, and give them open access to check the figures should they want it, then you're going to get to the bottom end of these brackets, of these ranges. And if, say, you were in one of these top two categories and still got a penalty, then what you can also do is apply for it to be suspended for a year. It's a bit like a suspended prison sentence. You have a year to act properly, to be a good boy or girl, and at the end of that, then the penalty gets waived as long as you don't transgress again. Just to summarize on that, better to come clean than to get caught. And it's not, you're not going to be sent to jail and the keys thrown away. It's about avoiding penalties, and it can be done in such a way as to, in most cases, to get the penalty down to 0. Okay, so that's it for all of the technical content. Thank you very much for listening. I'm just seeing the number of participants has held up, so that's great. Please feel free to contact me after this event if I can help with any specific questions. We'll have a Q&A session in a minute, but in general, how I will work is I will always try and minimize your overall tax liability by looking at the whole picture and that of your families. I really major on the advisory side of what I do. A lot of high street accountants will tend to be more what I'd call compliance accountants. They'll crunch the numbers, they'll submit your tax returns, but you won't get an awful lot of advice over and above that. Whereas the way I operate is the reverse of that, really. And as I've said, and as Vanessa said in her introduction, I've got quite a lot of property experience myself, but I've been doing it on and off since I was in my 20s, which is wow, too long ago to even contemplate for too long. And in terms of pricing, I'm very transparent with pricing. I like to have total clarity, agree a fixed price up front for the year. I think I'm competitive. I'm a sole practitioner. I don't employ staff. I work from home, keeps my costs low, and it means that I can offer competitive prices for what I do. I'm not the cheapest. To be honest, you don't want to go with the cheapest because you won't get any service. You certainly won't get any advice. Yeah, better to get someone who's going to actually help you and give you some advice. So thank you very much. There's my contact details there. I think Vanessa's going to circulate the slides, and there's the recording as well. So thank you very much. I think I'll stop screen sharing now and look for a cue from Vanessa. So I think, yeah, I'll just quickly go through, or as quickly as I can, go through these questions in the chat. Is that okay, Vanessa?
Yeah, just before you do that, Rob. So thank you for, yeah, that's great. Thank you very much for doing that. Before we move into the Q&A, and there are a good few questions in the chat box, which is great. And if we get the opportunity, like I said, we'll be able to open your unmute you so you can ask a couple of live questions to Rob. But just as a sort of appreciation of you also attending this evening from VA's side of things, I am giving out 8 free one-to-one landlord telephone or Zoom consultations to anybody who wants to ask me anything on the general property front. I get asked a lot of questions. I get asked for a lot of referrals to different experts. So if you have any questions about your landlord portfolio in general, tonight obviously is all about tax. But if you're thinking about things like, are you getting the right rent for your properties? What type of properties to buy if you're looking to increase your property portfolio? Any concerns to do with property legislation, which is constantly changing, certificates. I'm giving out 8 free landlord consultations. I'm going to drop a link now actually in the chat for you. If you click on this link, you'll be able to book that with me if you're interested. Like I said, there's only 8 because although they do take a bit of time, but I'm more than happy to go through your personal property portfolio, your growth plans, and just explain away any concerns or issues you have. I had a landlord contact me today who said he had a great tenant in the property. He's been there for years and years and years, but it turns out that he's getting about £300 below the market rent that he should be getting today, and he was a little bit confused as to how to put that rent up. So it's all about maximizing our income as landlords and saving on our tax expense, which is why Rob is here. But at the same time, you may be below the current rent in your local area. Certainly in Luton, I can tell you if you are. And there were ways that I advised that landlord this afternoon to increase his rent, not to the maximum of what he could get, because he has had a long-term good tenant in there, but how he could do what we call a staggered rental increase to get his rent up, yet keep a good long-term tenant happy. So there's all little tips and tricks that we do at VA through our experience in managing properties and letter properties. So feel free to click on the link and drop me a line if you'd like to have some time with me. And now, without further ado, we'll have a look at the chat box. And yeah, Rob, there are quite a few questions. If we scroll right back to the beginning of the questions, so that way we don't miss anybody out. I'll read them out, and then you can see where you go from there. So we have a question here that says, is interest charged on the 12 monthly tax installments?
Yes, and thank you to Anthea for bringing that one up, because I meant to mention when I was covering that point is that although the deadlines for submission and payment are extended, you still have to pay interest, but the interest is only 2.75%. So it's not a massive rate, and unless you owe an absolute fortune, it's not, probably not going to be not going to change your decision. But it is charged, yes, on the 12 monthly tax instalments. Okay,
thank you. There was a general question: will the recording be available? Yes, we'll circulate the recording after the meeting tomorrow by lunchtime. In terms of more questions, there is a question here that says, could you give us some more information on the change from April 2024, which you mentioned? Could you explain that a bit more?
Yes. So yes, I'm not quite sure. Not quite sure how really. So because all I can, because this has been so I think it's probably best if I just give you a bit of the background to the whole Making Tax Digital initiative. It's been around for years, and it was presented as this grand vision whereby everything would be self-populating, and in the case of self-assessment, for example, taxpayers, it'd be so much easier for us all. We'd just go online. Most of it would be pre-populated, and there'd be a minimum that we'd have to input and so forth. And they tried first to introduce it for VAT only, for businesses, for VAT returns. And it kept getting put off, mainly because of so much backlash against it, and also because Brexit was happening at the time, and the government had enough on their plate without dealing with another difficult issue. And in the case of VAT, it's all been watered down. So in theory, a business that submits VAT returns needs proper accounting software like Xero or QuickBooks or whatever it may be, and there's a link between those systems and HMRC, in this case HMRC's VAT software. In reality, there's a compromise, and businesses don't actually need to use these systems. You can use a spreadsheet, but the minimum is you're going to need a spreadsheet. And I think when it gets rolled out to landlords, I would like to think that you can still get away with needing a spreadsheet rather than having to sign up to Xero or QuickBooks or any of those, because at the end of the day, if you just got one or two properties, it's quite a big cost. Xero subscription is about 25 pounds a month, I think now.
Yeah.
So you don't want to be paying, plus VAT, of course. So which makes it 30. So you don't want to be paying another 360 pounds a year out if you've only got one or two properties. So I think it does remain to be seen. But if you are one of the people who've got the cardboard box full of receipts at the end of the year, the minimum you're going to have to do is to put them on a spreadsheet to link with the system. But it is still it does still remain to be seen exactly how that's going to be applied to landlords. So hope that answers the question.
Thank you, Rob. Have an interesting question here. We get asked this quite a lot at VA.
Mm-hmm.
A question is, what are the chances of being caught by HMRC if you've not been filing a self-assessment? Asking on behalf of a friend, because we are all law-abiding citizens here.
Absolutely,
I get asked that question quite a few times. Landlords say, has HMRC ever approached us as an agency to open our books and send them all the details of our landlords? In my 14 years of having a business, I've never been approached by HMRC yet. I have heard it's something that can be done, but it's never happened on VA's watch. So over to you, Rob.
Yeah, I think that they'll be getting the information from the mortgage lenders. So if you've got a buy-to-let mortgage, you're probably most at risk. But I think they're fairly high, to be honest. It may not be immediately, may not be next year, may not be the year after, but it is an area that they're targeting. I suppose I don't really get experience of how high the charges are, because my clients, by definition, my landlord clients, are already declaring their income, which is why they use me. But I certainly get it a lot with with non-UK nationals who've got overseas income, they get caught an awful lot, and most of the time it's quite innocent on their part. But with property, yeah, I think that there is quite a strong chance, particularly if you've got a mortgage, because at the end of the day, you know, everything about you is out there in the metasphere, I think we're supposed to call it now, yeah, and HMRC do have access to it, and landlords, you know, are an easy target in a lot of ways. So I would definitely urge, you know, anyone in that situation to you know, seek advice and you know, think seriously about fessing up.
Okay, I'll try and whip through some of these questions because we're just conscious of time. We've got another sort of 5-7 minutes.
Okay.
So I'll try and sort of pick some of the more general questions that I feel might help everybody. There's a question here that says, are there any fixed expenses that you can claim each year as reoccurring that HMRC is reasonable without asking for any proof?
Well, I mean, I think on the thing about without asking for any proof, I mean, the thing that people need to understand is that the whole tax system works on a self-assessment basis. So, you know, you declare, you know, on a sort of honest basis, and it's only in exceptional circumstances that you will be asked for proof. And you know, HMRC have got all sorts of software which sits there looking at ratios and looking at, you know, outliers and exceptions to the norm, and you know, does target those people for investigation. And you know, being investigated is a very uncomfortable experience, but you know, aside from that, you do need to have, you know, proof or backup to you know, everything that you claim, really, because, you know, it could be you, and there are a certain number of random tests as well. There's not very random checks. There's not very many, but they do exist. So and as for the first part of the question, reoccurring expenses, not the same amount every year, but yeah, be the same expense headings, but yeah, you need to be specific about the amounts. They need to be actual, or if you can't access the actuals for whatever reason, they need to be a reasonable estimate, and they need to have something sitting behind them in case you know, HMRC do look at them.
Okay, another question here. We'll do this question, then one more. I thought the tax allowance on mortgage interest was not allowed anymore. Is there a different way to claim this in the self-assessment?
Yes. So I think what the question correctly states is that you can no longer claim mortgage interest as an expense against your income, but you can deduct 20% of it from your final tax bill that's worked out without that interest being, you know, above the line, so to speak. And I tried to demonstrate the effect of that in the example, with the result being an increase in tax from whatever the number was, 6,000 something, about £1,300 in the particular example. So yeah, hopefully that clarifies it. But yeah, please get in touch afterwards if you want me to go through it again.
And I think this is a good question for our final question, one of our final questions to end on for the evening, because it probably applies to a lot of people who are not local to their property. And you mentioned this earlier. If you own 3 properties and travel from home to each property on separate days, can you claim the travel allowance for each journey, even if this is to check check the internal status of the property, general upkeep? So maybe if you're traveling to and from your properties to do inspections and repairs and things like that.
Yeah, I mean, if you know, within reason. I mean, if you're traveling there every day, then it might stretch credibility a little bit, but you know, especially if there's a nice pub next door or something. But yeah, you can. There's no limit on it, but you know, again, it needs to be real.
And someone's asking, if I invest in a property abroad, am I supposed to pay tax both in the UK and in the foreign country?
The short answer is it's complicated, but the simple answer is probably not. So provided the UK has got what's called a double tax treaty with the country where you buy the property, then you will only pay tax in one country or other. And if you're a UK resident, you will normally have to pay the tax in the UK. Now, if there's not a double tax treaty and if there is a double tax treaty and the other country tax you as well, then you can offset the tax that you've paid abroad against your UK tax. So the principle is you only pay tax in one country, and if you're a UK resident, that country would be the UK.
And I think in terms of time, what I've just dropped in the chat box, Bob, is that for any questions that we haven't had time to answer, because we are literally on our hour, which is great, we'll go through them, and if they're sort of generic type questions, if you can then drop me a line, then I'll circulate the answers to those questions with the recording, so that way you know, everyone gets hopefully a chance to have their questions and concerns addressed. Like I said, up here I'm available if you'd like to drop me a line through the link I put in the chat box. I can address any of your property questions or concerns at a later date, but I think our time is now fast spent. So the last thing I just wanted to say is obviously thank you for your time this evening. This is the first of a few what we call VA expert webinars that I'll be running this year together with my team, approximately every 3 to 4 months. The next one we're looking to do will be about finance for growth. So I presume everybody here has a property or two, or if not more. We'll be bringing in a finance expert that will talk to us about how to, if you're looking to grow your property portfolio, some sort of really good finance options that you should be looking at to do that in the best way for you. So and if there's any other topics that you would like us to cover as an agent, please feel free to drop that in the chat box as well, because all ideas are welcome. If I don't know the expert personally, I will go and look for one to help and bring more support to our landlords, really. So thank you everyone for your time this evening. I hope it was useful, informative and beneficial for you tonight. And Rob, thank you so much for being a tax, thank you for being a tax expert tonight, and I'm sure we'll catch up a little bit later. So we wish everyone good night, stay safe in the current times, and we'll see you at the next VA expert webinar. Good night.
Thank you. Good night.